The average American household needed an income of $107,000 a year to afford a median-priced home in 2024. In 1985, that number, adjusted for inflation, was $54,000. The housing market is, by every measure, the least affordable it has been in 4 decades. Mortgage rates are near 7%. Prices are still 47% above 2020. Inventory sits at roughly half of what economists consider a balanced market. And yet the market is not correcting. Prices are not falling. Sellers are not rushing to the exits. The crash that has been forecast, debated, and feared since 2022 has not arrived. So either the traditional measures are broken, or something is holding this market up that nobody is discussing loudly enough. That something is not a mystery. It is a number. 92% of the mortgages currently active in the United States were locked in below 6%. And that single fact has quietly rewritten the rules of how a housing market is supposed to behave when interest rates rise. The question is not whether this can last. The question is what happens when it stops. To understand why the housing market is behaving the way it is, you need to go back to March 2022. That is when the Federal Reserve began what would become the fastest interest rate hiking cycle in more than 40 years. In the span of 16 months, the federal funds rate went from near 0 to 5.5%. The stated goal was straightforward: cool an economy running too hot, bring inflation back toward 2%, and in the process, take some air out of an asset bubble that had been inflating since the pandemic began. Housing was explicitly part of that calculation. Fed Chair Jerome Powell acknowledged in 2022 that the housing market would need to go through a correction to get back into balance. The logic was textbook. Higher rates mean higher mortgage rates. Higher mortgage rates mean higher monthly payments. Fewer buyers qualify. Less competition. Sellers cut prices. Prices fall. Market rebalances. Simple. Except the market did not read the textbook. Between early 2022 and late 2023, the average 30-year fixed mortgage rate went from roughly 3% to just above 8%, the sharpest move in mortgage rates in modern American history. And what happened to home prices over that same period? They fell briefly by about 5% nationally in late 2022, then turned around and kept climbing. By 2024, the median home price in the United States had reached $420,000, a new all-time record. The market that was supposed to correct had instead set a new high. The Federal Reserve had pulled the lever it always pulls. The lever had snapped. To understand why, you need to understand a number that is rarely discussed with the weight it deserves. During the pandemic, when the Fed held rates near 0, tens of millions of American homeowners refinanced their mortgages at historically low rates. The volume was staggering. In 2020 and 2021 alone, Americans refinanced or originated more than $9 trillion in mortgage debt. As of 2024, approximately 92% of all active mortgages in the United States carry an interest rate below 6%. More than 60% carry a rate below 4%. These are not short-term adjustable instruments. These are 30-year fixed contracts, which means the people sitting on those mortgages have no financial incentive to sell their homes, move somewhere else, and take out a new mortgage at 7%. For most of them, doing so would roughly double their monthly housing payment, even buying a cheaper house in a cheaper city. A homeowner with a $400,000 mortgage at 3% pays around $1,686 a month in principal and interest. That same loan at 7% costs $2,660. Nearly $1,000 more per month, every month, for 30 years, simply because they moved. The lock-in effect did something no one in the Fed's models had fully anticipated. It did not just reduce demand, it collapsed supply. Homeowners became, in a very practical sense, trapped by the best financial decision they ever made. Existing home sales fell to their lowest level since 1995. The number of homes listed for sale in the United States dropped by roughly 40% between 2022 and 2023. The Fed had raised rates to cool a hot market. What it had actually done was freeze it. And a frozen market does not behave like an overheated one. It behaves like something the standard models were not built to measure. The question that follows is not simply why prices did not fall. The real question is what kind of market emerges when everyone who owns supply has every reason to hold and no reason to sell. That answer turns out to be more structurally strange than a correction would have been. The relationship between interest rates and home prices is one of the most well-documented in all of economics. It is not a theory. It is a mechanism that has been observed, tested, and validated across multiple decades and multiple countries. When the cost of borrowing rises, the pool of buyers who can afford to participate shrinks. When the pool shrinks, sellers face less competition for their properties. When sellers face less competition, they lower their asking prices. That is the chain. And in virtually every modern housing cycle before 2022, that chain held. After the savings and loan crisis of the late 1980s, rising rates contributed to a housing correction that lasted years. After the dot-com bubble, a cooling rate environment helped stabilize a market that had started overheating in coastal cities. And most dramatically, after the 2008 financial crisis, the most severe housing collapse in American history, the model seemed to confirm itself in brutal fashion. Prices fell 30% nationally. Millions of homeowners went underwater. The mechanism worked exactly as described, if more violently than anyone had hoped. So, in 2022, when the Fed began hiking, the analytical consensus was not complicated. Rates go up, monthly payments go up, buyers drop out, supply absorbs, prices moderate. This was not a fringe forecast. It was the baseline expectation of the mortgage industry, the Federal Reserve itself, and virtually every major real estate research firm in the country. Goldman Sachs projected a 10% national price decline. Morgan Stanley projected a similar correction. The National Association of Realtors forecast that sales volumes would fall sharply as affordability deteriorated. All of these projections were directionally correct about one thing. Demand did fall. Mortgage applications collapsed. Purchase loan originations in 2022 dropped to their lowest level in 25 years. First-time buyers, who depend almost entirely on financing, effectively exited the market. The demand side of the equation behaved exactly as the models predicted. The supply side did not. And this is where the dramatic irony of the situation becomes almost clinical in its precision. Every previous housing cycle that economists used to build these models shared one critical feature. The sellers were not the same people as the buyers. In a normal market, someone who bought a home in 2015 at a 4% rate might decide to sell in 2022 because they want more space, or they are moving for work, or their family circumstances changed. Their decision to sell is driven by life, not by the mortgage rate environment. They list the house. A new buyer comes in at whatever rate the market offers. The inventory replenishes. Prices adjust. But 2022 introduced a variable the historical models had never encountered at scale. For the first time in modern memory, the people who owned the housing supply were also people who held a financial instrument, their mortgage, that was worth more than money. Giving it up meant an immediate and permanent increase in their largest monthly expense. So they did not give it up. And when sellers stopped selling, the inventory that buyers need to create price competition simply does not exist. Demand fell as expected. Supply fell faster, which is the only mathematical explanation for why prices went up in a market where everyone agreed they should go down. The Fed had used the right tool. It had just applied it to a market that had been fundamentally rewired, and the rewiring had happened quietly. During the 2 years, everyone was focused on something else. The rewiring happened between March 2020 and December 2021. And to understand its full consequences, you have to look at what the housing market actually produced in the years that followed, not what the policy was designed to produce. The Federal Reserve raised rates to reduce housing inflation. What it actually produced was the worst housing affordability crisis in 4 decades. That gap between intention and outcome is not a matter of opinion. It is documented in the data. The National Association of Realtors publishes a monthly affordability index that measures whether a family earning the median income can qualify for a mortgage on a median-priced home. A score of 100 means the math works exactly. A score above 100 means the typical family has more income than the minimum required. A score below 100 means they do not. In 2020, the index sat comfortably above 150. By late 2023, it had fallen below 100 for the first time since 1985. The policy designed to fix the affordability problem had made it measurably worse than it had been in 40 years. To understand how this happened, you need to add one more variable to the model. When existing homeowners refuse to sell, the only new supply that can enter the market comes from construction. New builds. And in theory, this is where the market should have self-corrected. If existing inventory dries up, builders step in, increase supply, and prices stabilize. That is how it is supposed to work. But construction operates on its own timeline, with its own financing constraints, and its own sensitivity to interest rates. Builders borrow money to finance development. When rates rise, their cost of capital rises too. When their cost of capital rises, the price at which a new home becomes profitable to build also rises. So in the period when the market most needed new supply, the economics of building new homes became significantly less attractive. Single-family housing starts fell 17% between 2022 and 2023. The new construction pipeline, which was already running below historical averages after a decade of underbuilding following the 2008 crisis, tightened further. The market was losing supply from two directions simultaneously: existing owners who would not sell and builders who could not profitably build. The result showed up in inventory numbers with uncomfortable clarity. At the peak of the supply crisis in early 2022, the United States had approximately 1.9 months of housing supply available, meaning that if no new homes were listed, the entire existing inventory would be absorbed in under 2 months. The historical average for a balanced market is 6 months. At 1.9 months, there was no mechanism through which price competition between sellers could function. You cannot have a buyer's market when there is almost nothing to buy. And yet the buyers had not disappeared. They had been reduced, yes, but not eliminated. The people who still needed to move, still needed to buy, were now competing over a drastically smaller pool of available homes. That competition, in a market with less than 2 months of supply, does not produce price declines. It produces bidding wars, which is exactly what the data recorded. The question this raises is whether the supply problem was a temporary disruption or something with a longer structural life. Because if the lock-in effect persists as long as the rate gap between existing and new mortgages persists, then the market is not experiencing a short-term freeze. It may be experiencing a new baseline. If 1.9 months of supply was the floor, the question becomes how far above it the market has managed to climb, and what that recovery actually looks like in practice. By mid-2024, available housing inventory in the United States had recovered to approximately 3.7 months. That is a meaningful improvement from the crisis lows of 2022. It is also still roughly 40% below the 6 months that economists define as a balanced market. The runner has moved. It has not arrived. And that gap between where inventory is and where it needs to be to produce genuine price competition is not closing quickly because the underlying dynamic that created the shortage has not changed. 92% of active mortgages are still locked below 6%. The incentive structure that froze supply in 2022 is still the same incentive structure that governs every listing decision in the market today. What has changed is who is participating, and what that reveals about where the consequences of this freeze are actually landing. The most direct measure of who a housing market is working for is the first-time buyer share. In a healthy market, first-time buyers represent roughly 40% of all home purchases. They are the entry point of the entire system, the people forming new households, leaving rentals, beginning to build equity. Without them, the chain of move-up buyers that generates resale inventory cannot function. In 2023, the first-time buyer share fell to 26%, the lowest on record since the National Association of Realtors began tracking the figure in 1981. The market had not just become expensive, it had become functionally inaccessible to the group that every functioning housing market depends on for its base layer of demand. The people being priced out are not making poor financial decisions. They are encountering a mathematical reality. The median monthly mortgage payment on a median-priced home in 2024, at prevailing rates, was approximately $2,200 before property taxes, insurance, or maintenance. That figure represents more than 30% of the pre-tax median household income in the United States. 30% is the traditional federal threshold above which housing costs are classified as a burden. The median home is now a financial burden for the median household. That sentence would have been unremarkable at the peak of the 2008 bubble. The critical difference is that in 2008 the market corrected. Here, it is not. And the consequences of that non-correction are not abstract. They are behavioral and measurable. Household formation in the United States has slowed materially since 2022. Young adults aged 25 to 34 are living with parents or roommates at rates not seen since the 1940s. Geographic mobility, the rate at which Americans relocate between cities and states, has fallen to its lowest level since modern data collection began. The housing market is not just unaffordable, it is beginning to immobilize the labor market, slow family formation, and reshape the demographic patterns that feed long-term economic growth. A market this frozen does not correct quietly. It builds pressure across every layer of the economy it touches. And the question is not whether that pressure has consequences. It already does. The question is whether those consequences will eventually force the correction the market has so far refused to make, or whether something else entirely will release the valve first. There is a narrative that has become politically useful in the debate about housing affordability, and it goes like this. The reason ordinary Americans cannot afford to buy homes is that large corporations and institutional investors have swooped in, purchased enormous quantities of single-family houses, converted them into rentals, and in doing so have both removed supply from the ownership market and driven up prices for everyone else. It is a clean story. It has identifiable villains. And like most clean stories about complex systems, it is partially true and significantly overstated. And understanding exactly where it is true and where it is not turns out to matter quite a lot for reading where this market goes next. The institutional presence in single-family housing is real, and it is large. In 2023, in key Sunbelt markets, Atlanta, Phoenix, Dallas, Charlotte, institutional investors accounted for approximately 26% of all single-family home purchases. Companies like Invitation Homes and American Homes for Rent collectively own hundreds of thousands of properties across the country. The entry of institutional capital into the single-family rental sector at this scale is a genuinely new phenomenon. It did not exist in any meaningful form before 2012, when private equity firms began acquiring distressed properties in bulk after the 2008 collapse. What started as an opportunistic play on depressed assets has since become a permanent and growing asset class. But the 26% figure, while striking, requires context before it can tell you anything useful. Nationally, institutional investors account for somewhere between 2 and 3% of total single-family home purchases. The concentration in specific markets is high. The national footprint is not. And in the markets where institutional presence is highest, the underlying affordability problems existed before the institutions arrived. Phoenix, for instance, had been experiencing supply shortages and price appreciation driven by population inflows and construction deficits long before Wall Street discovered the single-family rental trade. The institutions moved into markets with existing structural imbalances. They did not create those imbalances. That distinction matters because it changes the diagnosis. If institutional buying were the primary driver of prices, removing it would produce a correction. But if institutional capital is filling a vacuum created by the lock-in effect, providing rental supply in markets where ownership supply has been frozen, then its removal might not lower prices at all. It might simply reduce the supply of rental housing, making that market worse while leaving the ownership market unchanged. This is the micro-loop at the center of the institutional investor debate. Are these buyers the cause of the affordability problem, or a symptom of a deeper structural failure that would persist even if every institutional landlord sold tomorrow? The answer, based on available data, leans heavily towards symptom. But that does not mean institutional capital is neutral in its effects. In the specific markets where it is most concentrated, the data does show measurable price inflation attributable to institutional demand, estimated between 2 and 5% in the hardest-hit areas. That is not nothing. It is also not the whole story. And the whole story matters because if the valve that releases this market is not the departure of institutional investors, then we need to find the valve that actually exists. The valve that actually exists is not a policy lever. It is not an institutional exit. It is not a recession, a job loss wave, or a sudden collapse in demand. The valve is a number, and it is the same number we planted at the beginning of this video. To find it, you first need to accept a reframe that changes everything about how this market looks. The question that has dominated housing commentary since 2022 is, why won't prices fall? That is the wrong question. Prices are not the only way a market corrects. Markets can also correct in volume, in mobility, in accessibility, in the number of transactions that actually clear. And on every one of those dimensions, the American housing market has already corrected, dramatically and on the record. Existing home sales in 2023 fell to approximately 4.1 million annualized units. That is the lowest figure recorded since 1995. For context, in a healthy and normally functioning market, existing home sales typically run between 5 and 6 million units per year. The market did not fail to correct. It corrected in every dimension except the one that generates headlines. Prices held. Everything else collapsed. And once you see the correction that actually happened, the market stops looking irrational and starts looking like something under extreme structural compression. Here is the reframe. In a normal market, prices and volume move together. When demand falls, both the number of transactions and the price per transaction decline in tandem. What happened in 2022 and 2023 was structurally different. A market in which the supply side was so thoroughly immobilized that falling demand could not translate into falling prices, because there was never enough inventory for price competition to function. The correction happened. It just happened to the people who needed to participate in the market, not to the people who were already in it. That is not a market ignoring reality. That is a market that has created a new reality, in which the benefits of the pandemic-era rate environment have been permanently captured by the people who were already homeowners in 2020, and the costs have been permanently transferred to everyone who was not. The wealth effect of that transfer is not trivial. The aggregate value of the low-rate mortgage subsidy held by existing homeowners has been estimated at over $1 trillion, the difference between what they pay today and what the same debt would cost at current market rates. A survey conducted by John Burns Research in 2024 found that 84% of homeowners with a mortgage below 5% said they would not sell their current home even if they wanted or needed to move, specifically because of the rate differential. 84%. That is not a marginal effect at the edges of the market. That is a near-total freeze of the resale inventory's willing sellers. The implications of this reframe are significant, because if the market is not overheated but compressed, if it is behaving like a spring under tension rather than a bubble waiting to pop, then the question of what happens next is not about when it crashes. It is about what happens when the compression releases. And the compression will release. The mechanism is already written into the math. When mortgage rates fall to a level where the gap between existing rates and new rates narrows enough that moving makes financial sense again, millions of locked-in homeowners will make that decision within a compressed window. The spring does not unwind gradually. It unwinds all at once. If the spring unwinds all at once, the obvious question is what policymakers have done to either prevent that scenario or prepare for it. And the honest answer is that the interventions tried so far have produced results that range from modest to negligible. Understanding why requires tracking 3 separate attempts to fix a market that, as we have now established, is not broken in the way the fixes assumed. The first and most anticipated correction came in September 2024, when the Federal Reserve began cutting the federal funds rate for the first time since the hiking cycle began. The logic was straightforward. Lower the policy rate, lower the cost of borrowing, lower mortgage rates, unlock the lock-in effect, release supply. The market had been waiting for this moment for 2 years. Mortgage applications briefly spiked on the announcement. And then something unexpected happened. Mortgage rates barely moved. The federal funds rate fell by a full percentage point between September and December 2024. The average 30-year fixed mortgage rate fell by less than half that. The reason is a variable called the mortgage spread, the gap between the 10-year Treasury yield and the 30-year mortgage rate. In a normal market, that spread runs around 1.7 percentage points. During and after the rate hiking cycle, it widened to nearly 3 points as mortgage-backed securities investors demanded higher compensation for prepayment risk in a volatile rate environment. When the Fed cut, Treasuries rallied, but the spread stayed wide. The net effect was that the rate relief homeowners needed to justify moving never fully materialized. The second correction attempt came from the construction side. Home builders, facing a market where existing homeowners would not sell, recognized an opportunity and responded. Lennar, D.R. Horton, and Polt Group all deployed aggressive mortgage rate buy-down programs in 2023 and 2024, offering buyers below-market financing on new construction at significant cost to their own margins. New home sales held up better than existing home sales as a result. But new construction cannot solve the affordability problem at scale. The median price of a newly built home in 2024 was approximately $430,000, roughly $10,000 more than the median existing home, and out of reach for the first-time buyers the market most needs to absorb. Builders can build for the upper half of the income distribution. They cannot profitably build for the median household at current land, labor, and material costs. The third attempt has been the most discussed and the least delivered: zoning reform. A growing number of states, California, Montana, Florida, have passed legislation designed to allow more housing density in previously restricted areas. The theory is correct. More allowable units means more eventual supply. But zoning reform translates into physical housing on a 10 to 15-year timeline at best. Permitting, financing, construction, and absorption do not respond to legislative change in quarters. They respond in decades. The inventory runner, as of mid-2024, still sits at 3.7 months, unchanged from where it was when we last checked it, despite rate cuts, builder programs, and legislative reform. The market has absorbed 3 separate attempts at correction. None of them moved the fundamental number, which means the spring is still compressed, the rate differential is still the governing variable, and the mechanism that will actually matter is the one that is not triggered yet. The mechanism that has not triggered yet is not operating in a vacuum. While it waits, the market it will eventually move is not static. It is accumulating consequences that extend well beyond the question of whether home prices rise or fall. This is where the housing freeze stops being a story about real estate and starts being a story about the broader economy it is embedded in. The most immediate and measurable consequence is the collapse in transaction-dependent industries. The American housing market, when functioning normally, generates enormous economic activity that has nothing to do with the price of a house itself. Every home sale produces a commission for a real estate agent, fees for a title company, revenue for a mortgage originator, income for a home inspector, business for movers, and spending at home improvement retailers as new owners renovate their purchases. At 5 to 6 million transactions per year, these are not rounding errors in the economic accounts. The National Association of Realtors estimates that each home sale generates approximately $55,000 in economic activity beyond the transaction price itself. At 4.1 million sales in 2023, down from a peak of 6.1 million in 2021, the market was running roughly 2 million transactions below its healthy baseline. That gap represents approximately $110 billion in annual economic activity that simply did not occur. Real estate brokerages have cut staff. Mortgage originators, who processed nearly $5 trillion in loans at the 2021 peak, processed less than half that by 2023. Title and escrow companies have consolidated aggressively. The job losses in these sectors are real and documented, even as the housing prices that generate the headlines remain elevated. The second consequence is geographic. Labor markets depend on workers being able to move to where the work is. When housing mobility collapses, when people cannot afford to relocate to a new city, even if a significantly better opportunity awaits them, the efficiency of the entire labor market degrades. Economists at the Federal Reserve Bank of San Francisco estimated that the lock-in effect reduced labor market mobility by somewhere between 15 and 20% during the peak of the freeze. That is not a household-level inconvenience. That is a structural drag on national productivity, operating quietly beneath the surface of the employment statistics. The third consequence is generational and compounding. Every year that first-time buyers remain priced out of ownership is a year in which they do not begin building equity. The median American homeowner has a net worth approximately 40 times higher than the median renter, a gap that has widened steadily since the 1990s. The housing freeze is not merely preventing transactions. It is preventing the primary mechanism through which middle-class wealth is built in the United States from functioning for an entire cohort of would-be owners. And the longer it persists, the wider that wealth gap grows, not because the market is being deliberately exclusionary, but because the math of compound appreciation does not pause while people wait for rates to fall. The stakes of this freeze, in other words, are not symmetrical. The people inside the market are protected by an asset appreciating in their favor. The people outside it are accumulating a deficit they may never fully recover, and the distance between those two groups grows with every passing month that the spring stays compressed. The distance between those two groups, owners and non-owners, is not just a financial gap. It is increasingly a political one. And that political dimension is what makes the systemic stakes of this freeze particularly difficult to resolve, because the people with the most to lose from a housing correction are also the people with the most political power to prevent one. Consider the numbers. Approximately 66% of American households own their homes. Among voters aged 45 and older, the group that participates in elections at the highest rates, the home ownership rate exceeds 75%. These are people whose primary financial asset is the house they live in. Any policy that meaningfully reduces home values does not just affect their balance sheet. It affects their retirement security, their ability to fund their children's education, and the collateral that backs their access to credit. A politician who campaigned explicitly on lowering home prices would be asking the majority of active voters to accept a permanent loss on their most important financial asset. That is not a winning platform. It has never been a winning platform in any modern democracy where homeownership is widespread. And so the political system produces exactly what you would expect: policies that gesture toward affordability at the margins, down payment assistance programs, incremental zoning reform in states where legislatures can absorb the political cost, while carefully avoiding anything that would shift the price level in a material way. This is where Loop B closes. The institutional investors who have been blamed for the affordability crisis are, in the final analysis, operating within an incentive structure that the political system has chosen not to dismantle. They are not the primary cause of the freeze. They are one of its beneficiaries, along with the 75% of older voters who watch their net worth climb with every month that the market stays exactly where it is. The systemic stakes extend further still. Residential real estate and all of its related economic activity, construction, finance, insurance, property management, renovation, accounts for somewhere between 15 and 18% of United States GDP. A market running at 2 million transactions below its healthy baseline is a market that is leaving a meaningful portion of that economic contribution unrealized every single year. Local governments feel this acutely. Property tax revenue, which funds schools, emergency services, and infrastructure in most American municipalities, is directly tied to the volume of real estate transactions, because assessed values are typically reset at the point of sale. Fewer sales mean fewer reassessments, which in many jurisdictions means slower growth in the tax base even as the cost of services rises. The freeze is not just a problem for buyers. It is a slow fiscal drain on the governments that serve them, compounding quietly with each passing year of suppressed transaction volume. And none of this changes the fundamental math of what is still in place. Residential construction remains below the level needed to close the structural supply deficit building since 2008. The inventory runner sits at 3.7 months. 84% of mortgage holders below 5% are still locked in. Every variable that created this situation remains active, which means the event that finally changes it will not arrive gradually. The event arrives when a specific number is crossed, not a crash, not a policy intervention, not a recession, a rate. The threshold that researchers at the Federal Housing Finance Agency and multiple independent housing economists have identified cites at approximately 5.5% on the 30-year fixed mortgage. That is the level at which the financial penalty for moving, the monthly payment differential between an existing low-rate mortgage and a new market-rate mortgage, narrows enough that a meaningful share of locked-in homeowners will decide that their life circumstances outweigh the financial cost of giving up their rate. Children grow up, jobs change, marriages end, parents age. The life events that drive housing decisions do not pause for interest rates, they accumulate. And by the time rates reach 5.5%, millions of households will have been suppressing a move for 2, 3, or 4 years, not because they did not want to move, but because they could not afford to. At 5.5%, the estimate is that approximately 4.5 million mortgages currently in the lock-in pool would become candidates for release within a relatively short window. Now, detonate the gun that was loaded in the second block of this video. 92% of active mortgages are locked below 6%. More than 60% are locked below 4%. The 4.5 million figure represents only the fraction sitting closest to the threshold. The homeowners whose existing rates are between 5 and 6%, for whom the crossing of 5.5% on new mortgages makes the math of moving approximately neutral. They are the leading edge. Behind them, if rates continue falling, come the homeowners at 4%, then 3.5%, then the 60% sitting below 4%. Each tranche unlocks at a progressively lower rate level, but the 4.5 million at the threshold are enough to transform the market on their own. To understand the scale of that transformation, return to the inventory runner one final time. The market currently holds 3.7 months of supply. A balanced market requires 6 months. 4.5 million new listings, entering within the same 12 to 18-month window, would not merely push inventory past 6 months. Depending on the pace of entry, it could push the national supply figure to levels not seen since the immediate aftermath of the 2008 crisis, when inventory briefly exceeded 11 months and prices fell 30% nationally. The timeline would be faster, the volume more concentrated, and the market less prepared to absorb it, because a decade of underbuilding has left the infrastructure of the transaction economy, the agents, the title companies, the mortgage originators, operating at reduced capacity after 3 years of depressed volume. Here is the full irony of the situation. The buyers who have been waiting for lower rates, the first-time buyers sitting on the sidelines since 2022, the households whose formation has been delayed, the workers whose geographic mobility has been frozen, have been hoping for exactly the rate environment that would trigger the unlock. They want 5.5% mortgages, so do the locked-in sellers. When both groups enter the market simultaneously, the result is not the gentle, gradual rebalancing that the soft landing narrative promises. It is a simultaneous surge in supply and demand, hitting a market that has not processed normal transaction volumes in years. Whether that produces a correction, a boom, or something more disorderly than either depends entirely on the sequencing. The spring does not know how to unwind gently. It only knows how to unwind. The title of this video asks how long the housing market can ignore reality. That framing assumes the market is doing something irrational, that it is looking away from data it should be responding to, the way a trader might dismiss a warning sign or a regulator might overlook a systemic risk accumulating in plain sight. But the analysis we have just walked through suggests something more precise and more uncomfortable. The market is not ignoring reality. It is operating inside a reality that the standard models were not built to describe, and that distinction changes everything about how you read what comes next. The reality is this: a rate environment that has not existed at this scale in modern history produced a lock-in effect that has not existed at modern scale. That lock-in effect froze the supply side of a market in which the demand side was simultaneously compressed by the worst affordability conditions since 1985. The result was a market that corrected in every dimension except price, the one dimension that generates headlines. Transaction volume fell to 30-year lows. First-time buyer share hit a record low. Geographic mobility collapsed. Household formations slowed. That is not a market ignoring reality. That is a system responding rationally to a new set of incentive structures, in which the people who own the supply have every financial reason to hold it, and no financial reason to release it. Which means the answer to the question in the title is not a matter of psychology or sentiment or the collective courage of investors deciding to face uncomfortable truths. It is a matter of arithmetic. The housing market can ignore reality for exactly as long as the 30-year fixed mortgage rate stays above 5.5%. The day that threshold is crossed, and it will be crossed because rate cycles do not end at their peaks, the 4.5 million mortgages sitting at the edge of the lock-in pool begin to move. And behind them, as rates continue falling, come the tranches at 4%, at 3.5%, at 3%. The spring begins to release. The peripeteia in all of this is that the people who have been harmed most by the freeze, the first-time buyers, the young households, the workers whose mobility has been suppressed, are waiting for exactly the same thing that will trigger the most disruptive period of market activity in a generation. Lower rates are the relief they have been asking for. Lower rates are also the mechanism that ends the period of artificial scarcity that has been protecting existing prices. What comes next is not a market returning quietly to normal. It is a market negotiating at high volume and high speed between years of suppressed supply, years of suppressed demand, a structural deficit in new construction that predates the pandemic, and a political economy that has consistently prioritized asset values over transaction volumes. The outcome will not be uniform. Markets with high institutional concentration will behave differently from those without. Cities with strong population inflows will absorb supply differently from cities in demographic decline. What is uniform is the mechanism. The same number that built the freeze will break it. The answer to how long is the only honest answer available, until 5.5%. If you want to subscribe to keep following how this unfolds, that is the number worth watching. In your market specifically, what does local inventory look like right now, and how far is it from 6 months?